Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video, we're going to be beginning with the FM pre-September 2023 mock. In this video, entire section A has been covered. Please stay tuned for the next few videos for the further sections also. Let's get started. The first question says, which two of the following statements regarding profit are correct? So the first option is a primary objective of profit maximization is always beneficial for shareholders. So this may not be true. Why? Because while profits are important, they are not always the best measure for you to measure the company's performance. So shareholders may also be interested in risk. They may be interested in corporate social responsibility. So the first statement is wrong. Now let's move to the second one. Profit figures can be used as a good indicator to make investment decisions when comparing two companies. Now, this statement is also incorrect. Why? Because when you are comparing two companies, the return on investment rather than your simple profit will give you a better basis for investment decisions, because the return on investment will also consider how much capital that the company is actually using. Now let's go to the third statement. Profits relate to performance in the short term and so is not a good basis for long-term investment decisions. Now this is perfectly all right. Why? Because in the long term, if you are appraising an investment in the long term, you should also see that are they able to create value for the shareholders. Profits are only short term, but the long term thing is, are they able, whether or not are they able to produce value for the shareholders. So this statement is absolutely correct. Moving to the last one, profits can be manipulated by accounting policies and so are not the best measure of performance. Now, this is also absolutely true, as you might have also seen in papers like financial reporting. You see that using different kinds of accounting policies, like different methods of valuing inventory, different ways of charging depreciation, so profits can vary with these policies. So yes, profits are, calculated through various accounting policies and assumptions in place, and these are not the best measures for measuring your performance. Moving to question number 2, which two of the following are the features of financial accounts? So let's read the options. Prepared accounting format, uh, accounting to a format determined by management. No, the format is actually determined by the regulatory authorities. Management sets the format for your management accounts, right? The paper that we have studied in MA, right? Moving to the second one, concerned with the business as a whole. Now, this is absolutely true. Financial accounting will always be done for your entire business as a whole. It will mainly provide you with historic information, right? So this leads us to the third statement, primarily based on historic data. Why? Because financial accounts are always prepared. So when you prepare your balance sheet, you prepare your trading and profit and loss accounts, then they are prepared for the year that has just ended. So it is based on historic data. And the last one, why this is not correct, include non-monetary measures, because the financial accounts are mainly monetary in nature. They are concerned with the dollar values of things. They ignore qualitative aspects like the quality of your staff and so on. So this only considers the monetary measures. That is why option 2 and 3 is the right answer. Moving to the next one. Governments can pursue a range of policies to influence the economy. You have to match the government intervention to the type of policy. Now, what we will do over here is, first of all, let's recollect which policy deals about what. So, fiscal policy is basically about how government spends, how government borrows. Monetary policy is about money supply, interest rates, and everything, right? So, monetary policy, let's read the options. Increase the amount of credit available to consumers. So, credit again depends on interest rates, money supply. So, this will go to your monetary policy, and I can just drag this over to the monetary policy. I am not able to drag it at the moment, so I'm just going to match it over here. Moving to the next one, undertake a new program of spending on infrastructure. Now, again, as we discussed, fiscal policy deals with everything that the government spends and the government borrows. So this will go under your fiscal policy. Now, encouraging more saving by consumers. So, saving and spending by the consumers again talks about money supply. So, this will come under your monetary policy. Then I have maintain public spending levels while increasing tax revenue. So, everything about the revenues earned by the government, the spending done by the government again falls under fiscal policy. So, this is how you will drag and drop these in your exam. Moving to the next one. Okay, so I have to scroll everything. Right. We have the next question with us now. Which of the following statements is correct? Money markets are mainly used for personal finance needs. No, not at all. Money markets are used by financial institutions, by governments, and some companies are also, borrowing and lending money to each other. So, no, this is not for personal finance needs. Then, money markets are used to raise short term capital. Now, this statement is absolutely correct because money market instruments that we have learned of are generally those instruments which mature within a year. So let's read why the below options are not correct. Money markets operate solely between companies and banks. No, this is not true. Money markets involve institutions, governments, companies. So yes, the London Stock Exchange is an example of a money market. No, it is an example of a capital market, and they deal in medium and long-term securities. Moving to the next one, a UK bank is planning to borrow in US dollars. In which two of the following could it undertake the transaction? So, what are the possible options that they have? First is certificate of deposit. So now this is not a right option for them because why? Because certificate of deposit is basically a certificate which has a fixed maturity rate, maturity date, and also the interest rate is fixed. So if this corporate certificate of deposit is negotiable, it can be sold before maturity in the markets. So this is not something that the UK bank will be able to do. Finance house market, no, this is also not something that they can use. Because this is where financial institutes trade money market loans. So this is a UK bank, right? So now let's move to the other two options, which definitely have to be the answer. Let's understand why these are the right answers. Euro currency market. Now, euro currency market, it does not, the name may confuse you that it relates to currency of EU or anything like that. But it is basically the finance that is raised in a currency other than your domestic currency. So now the domestic currency of the UK bank will be GBP, which is sterling pound, and they are planning to borrow in dollars, which is not their currency. So that is why euro currency market is something that they could use to undertake their transaction. Now, interbank market, yes, definitely. Why? Because interbank market, as the name suggests, the banks can, lend and borrow, lend money and borrow from each other, and this is done in short-term loans. So yes, this can also be in any currency. That is why these two are the right options. Moving to the next one. This is question number 6. Coffee company has a daily demand of 30 bags of sugar every day for 7 days a week and 52 weeks a year. Each bag costs $1.5 each, and the cost of placing an order is $5 per order. Inventory holding costs are 10% of inventory purchase cost per annum. What is the optimal order quantity to minimize cost? Round your answer to the nearest whole number. So, we have to find out the EOQ over here. We also have the formula for EOQ, if I am not wrong, in the formula sheet. Yes, so this is the formula also given to us. This is an under root of 2 multiplied by cost of ordering multiplied by annual demand divided by annual cost of holding the inventory. So I'm just going to calculate this over here. As we read the formula, this is EOQ equals under root 2 multiplied by your annual demand. Now, how much is your annual demand in this scenario? Annual demand can be calculated as 30 bags every day multiplied by 7 days a week multiplied by 52 weeks in 1 year. So this is my annual demand, and this will be multiplied by your cost of ordering, which is $5 every order. This is given over here. and then this entire will be divided by how much is going to be my inventory purchase cost, 10% of that. So my inventory purchase cost is nothing but $1.5. So this is 10% of $1.5. And if I solve this entire equation, I will have my answer, and this comes out to be I have solved this on my calculator, and this comes out to be 853 bags. So I can just simply enter my answer over here, and I'm not able to get my keyboard over here. So yes, so this will be 853, and with this I can enter my answer and move on to the next question. Yes. So the following information is available for REL company. They have trade receivables, cash, liabilities, cost of sales. Assume 365 days. Current ratio is given to us. We have to find out the inventory turnover period. So inventory turnover is nothing but how much time it is taking for you to sell your inventory. Now we have our current assets, and current assets can be assumed to be cash, trade receivables, and inventory, since we do not have any other information. So if we use this information to find out our inventory, let's find out how much our inventory is going to be. So we have 3,400 worth of trade receivables, plus we have 1,200 worth of cash, and plus we have current liabilities. The current liabilities total is given to be 4,000. That means if I add inventory, this will come out to be 4,000. So that means the difference from these, I can get my inventory. Inventory is nothing but no, actually we have our current liabilities. My apologies. So plus inventory, and the current liabilities are given to us. So, and we also have our current ratio, right? So the current ratio is 1.75. So if I divide this by my current liabilities, which are 4,000, I will have my current ratio of 1.75. So how do I get to my inventory? For my inventory, I can find out 1.75 multiplied by 4,000 will give me the left right hand side of my figure, and then I can subtract these two figures. So if I solve this equation, I get my inventory as 2,400, and then I can use my formula for inventory turnover period. Inventory turnover period is nothing but inventory divided by your cost of sales multiplied by 365. So I can just put the values over here. Inventory is 2,400. Dividing this with 18,750, which is given to me as my cost of sales, and multiplying this by 365, I find my answer to be 47 days. And I can just type my answer over here, and this will come out to be 47. And I can move on to the next question. Right. So the next question, a company has seen an improvement on its return on capital employed. Which of the following statements could be a reason for this? So overhead costs have increased. So if overhead costs have increased, this will not cause your ROCE to improve, right? Selling prices have fallen. Again, selling price, if your selling price have fallen, that means again your ROCE will not be positively impacted. Sales mix has changed. Now, this is definitely something that can cause ROCE to improve, because maybe you are selling more of those products which give you a higher profit margin, or either you have been using your assets more efficiently. That is why you are able to improve your return on capital employed. So that is why sales mix has changed can be an option. Uh, right. Manufacturing costs have increased. Now, this will also not cause your ROCE to improve. So, I move on to the next question. I have South Company is a private company that wants to establish its cost of equity in order to evaluate a new investment proposal. North Company is a listed company that is very similar to South Company. South Company has a debt equity ratio of 1:3. North Company has a debt equity ratio of 1:4. North Company's equity beta is 1.5 and the corporation tax is 40%. Now we have to calculate the appropriate beta for South Company to use in its cost of equity calculation to 2 decimal places. Now, how can we find that out? First of all, we have to ungear the asset beta from North Company's equity beta. So we have the beta given to us as 1.5 over here. Let's de-gear this North Company's equity beta. So this will be the first we need to find out the beta asset. So for that, this will be 1.5 multiplied by how much is my value of equity. My value of equity for North Company is 4 divided by 4 plus 1 into my tax rate is 40%. So 1 into 1 minus 40%. So if I solve this entire equation, I will have my answer of my asset beta as 1.304. Always remember that your beta equity will be greater than your beta asset. So if you are getting a figure that is, always your answer for beta asset will be lesser than what your beta equity is. Now let's move to the second step. What is our second step? We have to re-gear this according to South Company, which is originally our company. So we will re-gear it according to the debt equity ratio of 1:3. So how will I find that? I will re-gear this according to South Company. Re-gearing beta equity can be found out as 1.304 multiplied by value of equity. I will take 3, with 3:1 is the ratio, plus 1 into 1 minus 40%, and I will divide this by 3, which is my value of equity, and with this I will find my answer as 1.56. So if I just enter this over here, I have to answer in 2 decimal places, so I will just type 1.56 and I am done. Moving on to the next question. A summary of company's recent statement of profit or loss is given below. We have the revenue, cost of sales, okay. We need to find out the operational gearing. So to find out our operational gearing, first of all, let's write the formula. The formula for operational gearing is contribution divided by PBIT, which is profit before interest and tax. So how do we find that out? First of all, we have the revenue. In the numerator, we have contribution. So revenue is 15,000 minus. We know that 50% of cost of sales and 20% of expenses are my variable costs. So I have to subtract my variable cost from my sales. Sales I have already taken 15,000. Now I want my variable costs, which is 50% of cost of sales and 20% of expenses. Cost of sales is given to me as 8,000. So 50% of 8,000 is 4,000. And then I'm going to subtract 20% of expenses. Expenses are 2,000. 20% of 2,000 will be, if I just find out the 20% of 2,000, this will come out to be 400. So this is my numerator, and I have my PBIT straight away given to me as 5,000. So if I just solve this entire thing, 15,000 minus 4,000 minus 400 and dividing this with 5,000, I have my operational gearing as 2.12, which is my final answer. Moving on to the next one. A company has listed 6% bonds redeemable in 3 years. Investors require a redemption yield of 8%. What is the current market value of each $100 bond to the nearest dollar? So what we'll do over here is, how do we find out the market value? We find out how much money is it going to earn in the present value terms. So first of all, I have these bonds redeemable in 3 years. So I have year 1, year 2, year 3. So first of all, my interest is going to be a cash flow of $6 because 6% is the coupon rate, 666. And in the third year, I am also having my redemption. So nothing is mentioned. I will assume that they will be redeemed at their nominal value of $100. Then I use my discount rate according to 8%. So let's check in the formula sheet if we do have the factors with us. Yes, we do. So for 8%, we have 926, 857, 794. So this is what we are going to be using for our calculations. Also 0.926, 0.857, 0.794, and again 0.794. If we just multiply and find out the PVs and just add them up, we will get the market value. So 6 into 0.926 gives me 5.56. Solving this calculation, 6 into 0.857 gives me 5.14. 6 into 0.794 gives me 4.76. Then 100 into 0.794 gives me 79.40. And if I just add all of these values up, I will get 94.86, which is my market value. So I can just type this over here, my answer as 95, because they wanted to the nearest dollars. So 95 is my answer. Moving on to the next one. A company has in issue 1 million ordinary shares of 50 cents each. So 1 million is the number of shares. One share is 50 cents each. Market price is $2.5. The company plans to make a 1-for-5 rights issue at a price of $2 per share. What is the TERP per share to 2 decimal places? Now please note that we have to find out the TERP per share, right? So how will we do that? First of all, we have 5 shares because 1-for-5 rights issue. So 5 shares at 2.5. So if I multiply that, I will get $12.50. Then I am getting, for 5 shares, I am getting 1 share at 2. So this gives me $2. So then how much is my total over here? This is 14.5, and I am having these many number of shares. So my TERP per share will be nothing but 14.5 divided by 5 plus 1, which is 6, and this will give me 2.42, and this becomes my final answer. So I will just mention this in my answer box that this is 2.42. Now this is my answer. Moving to the next question. I have an investor creates a strategy based on an ability to gain access to relevant unpublished information. In which form of market would this be a successful strategy? So weak form efficient. Yes, definitely, because in weak form efficient markets, the share prices only reflect historical information. So if if the investor has gained some unpublished information, this will definitely provide him with an advantage. Now talk about semi-strong form efficient. Yes, this will also be helpful because in semi-strong markets, what happens is that historical and publicly available knowledge is incorporated. So if he gets to know something unpublished, then also he is going to have an advantage. Now strong form efficient. Strong form efficient, what happens? Every information gets reflected. Historical also, publicly available also, and unpublished also. So if that is already reflected in the share price, there will be no extra advantage that the investor will be able to gain. So that means this will be only helpful in your weak form and semi-strong efficient, which is option 1 and 2. Moving on to the next one. A company wishes to hedge against interest rate movements on a loan that it will take out in 6 months' time. It will borrow the funds for 6 months. So which of the following will be the best help hedge the risk? Now, sell interest rate futures expiring in 12 months' time. No, this is not the answer. Buy interest rate futures expiring in 6 months' time. No. Enter into a 6:6 forward rate agreement. No, this is not the best way because we want to borrow 6 months later and the borrowing will be for a period of 6 months. So this means we are borrowing 6 months later and then we have further 6 months that we need to borrow for. So this will give me an FRA of 6 to 12 forward rate agreement. So that is why this will be the right option. Moving on to the next one. This is the last question for section A. Which two of the following are methods of hedging against foreign currency risks? So, which two of the following can be used? Forward rate agreements. So, what happens in forward rate agreements? These are used for interest rate risk hedges that effectively fix the interest rate on future borrowing. So, this is not going to help you in your foreign exchange currency risk. So FRA is not your option. Then we have leading and lagging. Leading and lagging is definitely something that can be used in foreign currency risk, because here the company will either make payments in advance or they will delay their payments in order to take advantage of the exchange rate movements. So yes, this is something definitely that can be used to hedge foreign currency risk. Then we have matching. Matching is the process where receipts and payments in foreign currency are paired so that the receipts into foreign currency bank account are used to make payments in that currency. So yes, this can definitely be used. Now we have the last option as smoothing. This will definitely not be the right option. Why? Because smoothing is where you have a balance between fixed and floating exchange rate borrowing so that you can hedge your interest rate risk and not your foreign currency risks. So I will select option 2 and 3 over here and move on. With this, we have come to an end to section A of the FM pre-September 2023 mock. Please stay tuned for the next video. In the next video, we are going to be solving OT by OT, the 3 OTs, one by one in the coming videos. Thank you so much for watching. Please stay tuned for the next one.